Hi, everyone. Welcome. I am the Community Marketing Manager here at Verivest, and let's hope you're in the right place. Investing in trust deeds or mortgages, what you need to know with Heather Dreves. So who is Verivest? We are a real estate investment platform designed to bring transparency to trust in the middle market investing. So we are connecting deal sponsors with accredited investors to shortcut that time to trust. So we have the sponsor directory, which is super awesome. You can click on find a sponsor. You can sort by asset type. You can sort by minimum investment. You can search for MSAs, the region that you would like to invest in. You can also see on the right-hand side that you can see the background checks for all of the principals involved, as well as their background, and then you can connect with them as well. So that's super cool. So we have two verification requirements or two verification statuses. We have verified gold and Verivest verified. So the minimum to be on our platform, you have to have no personal or business bankruptcies, no unfavorably resolved lawsuits, no regulatory sanctions in the past 7 years, no felony criminal convictions, and sign the Verivest Code of Conduct. All right, so as you can see, Secured Investment Corp is a gold member, so they agreed to have 100% of their open opportunities monitored. So they are following the deal's operating agreement and allocating money that the way they said they would. They have investor capital managed amount of 20 million, and they are private lending for their primary strategy. Sponsors also can engage Verivest to verify their track record to make sure that this isn't their first rodeo and that they have been doing this, and we check all those assets for you. So you can see the investments on the left-hand side, the type of investment, the investment amount, and the inception date as well. All right, I know that was super brief, but we have an amazing guest with us today, so I don't want to take too much of her time away. So if you would like to connect with me or our community network, there's the link below, and as well as my phone number and my email. All right. So Heather, we have Heather here with us. She is the Director of Funding for Secured Investment Corp. She's worked in the private money industry for over 15 years. So she's coming with a lot of experience. She has been directly involved in the sale of over $75 million in trust deed mortgages and raised over $30 million in Secured Investment Corp's high yield funds. She also has experience with assisting in underwriting, managing the COGO and servicing team, in addition to investor relations. So I'm going to give the floor to Heather and stop sharing my screen and let you take it away, Heather.
All right. Thank you for having me. It's really an honor not only to be part of the Verivest community, but also to be able to put on this presentation. I think there's a lot of really good information out there. I know that Verivest does a great job relaying that info to their clients, but I think it's also important to, talk a little more granular about things.
If you guys have any questions during the presentation, feel free to drop them in the Q&A or the chat box, and we'll answer those at the end.
Over the last 5 years, everything is about funds, real estate funds, people investing in funds. And I think some people have lost sight or don't understand that there's also opportunity out there to actually fund trust deeds, or what some people call notes. Essentially, they're the same thing. But I think there's a lot of good opportunities with that. So I'm excited to talk about this topic today. So let's talk a little bit about investing in trust deeds and notes. Traditionally, institutional and ultra high net worth investors for decades have used this strategy as a wealth creation tool. Typically, to invest in trust deeds or notes, you would have needed many times over $250,000 just to buy one note. That has definitely changed. Pretty exciting. Our company actually originates loans down to $30,000. So we have notes and trust deeds in our portfolio that we are selling that you can actually invest with as little as a $30,000 minimum. So that's pretty exciting. Like I said, in the past, most of the time this opportunity was only open to very high net worth individuals or people that had really high dollar amounts to invest. So that is definitely something that has changed out in the marketplace. But let's talk about what a trust deed or a note really is, because a lot of people don't even understand that. They understand the funds and fund operators and managers that are pooling monies together. But I think it's important to talk a little bit about what it really means to buy a trust deed or a note. So when you invest in a trust deed or a note, you're acting as a bank. You're loaning your money to a borrower who's typically utilizing the capital to add value to a piece of real estate. We lend specifically to non-owner occupied properties and real estate investors. That is our niche. That doesn't mean that there's not other opportunity out there for buying notes or trust deeds that are actually secured by owner occupied, but we specifically focus around the non-owner occupied space. So when you buy a trust deed or a note, your name is recorded as the lien holder, making the respective property the actual collateral. So people ask, well, when I buy a trust deed or a note, what secures my money? The lien is what secures your money. You are now taking the place of the original lender or bank that lent the money, and now you're the lien holder against the property. So this collateral protects your investment. You earn monthly interest payments that are typically paid with principal returned at the time of payoff. That's just the way that we structure our notes. So our clients that buy our trust deeds or our notes are earning interest-only payments on a monthly basis. And then again, when that borrower pays off the loan or the loan matures, that principal is returned to them. So that's how you earn your yields on trust deeds or notes. So how does a trust deed and a note investing work? And this is specifically speaking to Secured Investment Corp, but this is pretty general practice out there. We house all the underwriting. So we house all the underwriting. That means that we have an origination team that originates the loan. We do the processing of the loan. We underwrite the loan. We have very specific guidelines. We have basically a checklist, and I'm going to show you guys what that checklist looks like here in a few minutes so that you guys can do your own due diligence. But we do the capital fundraising. We do the loan servicing internally. We do tax reporting, end of the year tax statements for both sides, for the lender that buys the trust deed, but also the person that's borrowing the money. We even have property management, foreclosure management if needed. So we are very organic in the sense that we keep all that in-house. We don't outsource those types of things. Typical loan terms. So if you're buying a trust deed from us, it's going to be anywhere from 6 to 24 months. This is a pretty average loan term for loans that are created for non-owner occupied property. So this type of lending is typically bridge lending that I'm speaking more specifically to. During that time, our typical rate of returns for our trust deeds are 8 to 11% annualized interest. So very good high yields, again, backed by a piece of security against that collateral. For each trust deed or note that you purchase, you do receive a recorded assignment of mortgage, a deed and an assignment of a promissory note. You also get title insurance and hazard or liability insurance that is transferred to you as the lien holder. And I'm speaking specifically to what we do at SIC, but I think this is really general practice because I can't tell you how many calls I get on a monthly basis that say, hey, Heather, I talked to you like 60 days ago. I hooked up with this real estate investor out of my local market. I lent him some money. I didn't do all these due diligence items, and now he's not paying me. I can't tell if I have a lien against the property. So I'm going to talk more specifically why those things are really important. So whether you're buying a trust deed or a note and investing in it from us or someone else, make sure you're looking for these things because they're so important to make sure that you're well secured and your money is protected. All right, so let's talk about, there's a few different types of real estate backed notes. You're going to typically learn about or see notes that are for sale that are either in a first lien or a second lien position. First and second refers to the position of the lien relative to the property or collateral that's securing the note. So it's super important. Remember, All first position notes have priority over a second position, and they must be satisfied before consideration of a second position note in the event of default. So for example, let's say you bought a second lien note and that first lien went into default and that borrower stopped paying that first lien. That first lien holder would need to notify you as the second lien holder and put you on notice that they were going to foreclose. That gives you as a second lien holder the ability to buy out the first to protect your second. If you don't do that, when that first lien holder forecloses, it's going to wipe your second out. So my point is second liens are risky, but that's not to say that there's not a lot of opportunity. So what you need to do is look at your due diligence process, make sure you fully understand, you know, what is encumbering the property in a first lien position. So in the event they are defaulted and they foreclose, as a second lien holder, you can step up, buy them out and protect yourself. We only lend in a first lien position, but I don't like to put a negative connotation on second lien notes because there's a lot of opportunity. Just make sure that you fully understand what you're getting into. But again, we only deal with first liens from our company's perspective. Then you have owner occupied versus non-owner occupied notes. Your non-owner occupied notes, that's what we specifically focus around, is going to be typically loans that were originated and notes that were created to provide funding to a real estate investor. Somebody's maybe buying a property, they're going to go rehab it, increase value, they borrow, you lien the property. That's a non-owner occupied. Owner occupied notes, which there's tons of opportunity with. It's not something that we focus on, but that's typically where you're going to be buying discounted notes. Maybe, you know, it's a pool of notes and a bank is selling those and they're discounting them and you can buy them because they're not performing. And I won't get into a bunch of, you know, go into the weeds with that, but there's strategies where you can buy them at a discount, get them performing again, and then sell them off again. So that's not our niche, not my expertise. We focus around, again, the non-owner occupied. Really, the main reason for that is it's a lot easier in the event of default to foreclose on a property that is non-owner occupied. As we all know, there's lots of, you know, regulations out there that protect people from being, you know, from their homes being taken from them in the event that they're not paying. So it's just a lot more difficult to foreclose on those types of loans and notes. So just something to be mindful of and understand, you know, when you're buying notes, what you're buying. All right, so again, performing and non-performing, there are two main statuses of real estate backed notes. Like I said, performing and non-performing, and then there's different levels when you start talking about performing notes. There are re-performing notes. So these could be a note that somebody else bought. Again, maybe it was defaulted at the time. That lien holder got them re-performing and now they're reselling it. Or sub-performing. This alludes to the length a borrower has consistently or inconsistently made payments. So maybe it was a defaulted note. Now they're back on track. So again, just understand what you're buying and what you're looking at when you're doing your due diligence. And I'm going to give you guys some tips on how to do that. When a borrower stops making their payments on their note, it is now a non-performing note. That's the reality. If they are not current on their payments, it is considered non-performing. There is a lot of opportunity to buy notes discounted doing that. So biggest thing, ask for pay histories. You know, if somebody's trying to sell you a note and it's an existing note that's been around more than a couple months, find out if they're current on their payments. It's pretty simple. All right, so a lot of people will ask me, you know, why do investors buy notes other than just the collateral? I hear from so many people that a lot of my note buyers were real estate investors. You know, they were somebody that started investing in real estate 15, 20 years ago, and they all have a story and they're all very similar. They'll tell me, hey, I was trying to get started, no bank would lend me money, but I had Uncle Joe that had some money, or my neighbor had some money, or someone I worked with. And people love the satisfaction and the feeling that they get when they help a real estate investor fund their project. You know, they're helping an investor create wealth for themselves, for their family. Many times these investors that are getting the funding are creating home ownership for first-time homeowners or affordable housing. So it's a great feeling that they're helping, you know, these people that probably normally wouldn't be able to go to a bank, not because of who they are, but because, maybe it's a distressed property, it needs rehab. So a lot of our clients get a lot of satisfaction knowing that they're helping somebody else. Unlike big banks or financial institutions that are hamstrung by red tape and government and corporate regulations, typically individual note investors can offer favorable terms and be more flexible than traditional sources of funding like a bank. Private investors are definitely more creative, and they can see potential in a distressed property and realize the upside in a completed project. So what's the risk? And everybody wants to know that. And I think that's an important thing to understand. Honestly, I probably scare off more people when they first start talking about trust deeds than people that actually jump into it with both feet, because I think it's super important to understand what the risks are, what the pros are, what the cons are. So every investment has inherent risks. Trust deeds and note investing has risk that lies in the illiquidity of the investment and the potential for the borrower to default on the loan. So our loans, our average terms 12 months. So once you buy a trust deed, you're in it till the end. I would love to say that at the end of every single loan term, that borrower magically pays off. That's not always the case. Some people have contractor issues and it took them longer to rehab it. Some people get it on the market a little bit later than they thought and it's still not sold, or it's under contract. So my point is, I've had people say, okay, it's a 12-month loan, so I get paid back right at 12 months. In a perfect world, yes, but that isn't always the case. And that goes both ways. Some of our borrowers pay off quicker, and we encourage them to do that because our cost of capital is not cheap. And, it's in their best interest to get in and out of these deals. They make more money, their profits are higher. But it's important to understand that, yes, there are loan terms specific to the promissory note, but be flexible with that, right? And most of our clients are, if it's a good paying borrower and the borrower needs an extra 90 days, they're going to give them an extension. They're getting great yields on their money. Why would they not extend them? And then the potential for the borrower to default on their loan. We, again, service our loans. And when a loan hits 30 days late, if they are not calling us back and that borrower is not figuring out a resolution to that problem within 45 days of their first payment missed, we will encourage the lender to let us start foreclosure, because the quicker that you can get that property back, the better off you are to mitigate the loss of capital to yourself. So what I tell people, whether you're buying a trust deed or a note from us, look for a servicer that will work on behalf of you as the investor with the borrower to resolve default issues that may occur. There are tons of servicers out there that all they do is collect payments. They don't do collection calls. They don't try to do workouts with borrowers. It is in everybody's best interest to work with that borrower and figure out a way to resolve the issues. So whether you're buying a note from us and servicing it with us, or you're doing something outside of us, make sure you have a good servicer that has your back, because that's really, really important. All right, so let's talk a little bit about some of the terminology. For those of you folks that are new to trust deed or note investing, there's some pretty general common terminology you guys are going to hear out there. And I think these are important terms to understand so that you can ask the right questions. So a lot of times, well, not a lot of times, but we always put these in our loan packages, is what is the purpose of the loan? Are they purchasing the property? Are they refinancing the property? Those are important to understand so that when you back through doing your due diligence, you can say, yeah, this makes sense, or no, they say they're purchasing it, but this property's been owned by them for 7 years. So it's important to understand their purpose. Market and appraised value, understand those. In the past, historically, everybody got appraisals. People are starting to go away from that. There are a lot of really good hybrid evaluation products out there on the market, but it's important to know what a third party has given an opinion of value on that property. After repair and as-is values, those are really important too. After repair is a value that a third party has given that property based off of rehab projects being done. So typically it's a distressed property, there's going to be rehab involved. That means there's going to be an increased value, and that's an after repair value. That value is based off the opinion of that third party, providing that work gets done. Then there's as-is value. As-is value is going to be the value of the property as it lies. So as it sits there today, we want to know what the value of that property is. But it's important to understand both of those so that you can understand what your risk is and your exposure. Loan to value. So this is your loan amount divided by your market or appraised value. So for example, loan amount of $100,000 that is divided by a value on the property of 200 gives us a 50% loan to value. That means we're not lending more than 50% of the loan to value, and there's a 50% equity play. And that equity position in these notes is what gives you peace of mind and lets you sleep at night, because you know, hey, I've got 50% equity. If I have to take this property back, I'm well positioned to get out whole. So it's important to understand that equation. Rate of return is going to be the rate an investor can expect to earn on their investment. Interest only payments compared to principal, interest, taxes, and insurance. Our payments our borrowers make are interest only. Some lenders, when they make a payment, that payment is dispersed to principal, interest, then taxes and insurance. Usually they're impounding. So understand how that payment structure is set up. Exit strategy, that's pretty simple. How the borrower plans on exiting the loan. That's everybody's question. How are you going to pay me back? You know, are you selling the property? You're refinancing. Hazard insurance, that's going to be your insurance that covers any losses to the property from, you know, weather, anything of that nature. And then title insurance. Understand how to read a title policy. Make sure you have free and clear title. I have lots of people that will call, same situation. I lent this guy money. Okay, did you get title insurance? You know, did you make sure there's no other liens? What is that? No, I didn't get title insurance. It's like, oh my gosh, you know, it's so scary. Make sure you understand title insurance and you can look at a title policy and read it. And if you don't know how to, you can reach out to me and I will help you. But it's super important. Okay, so once you're ready and you decide, great, I want to invest in trustees, I want to start looking at some, what are the next steps? So obviously there's due diligence on the project, the borrower, the property you're lending against. But I also think it's important to do your due diligence on the company you're buying that trust deed from. And I think that's where Verivest comes into play too. I mean, they do such an awesome job weeding out bad operators in this industry. It's just crazy how trusting people are. Please do your due diligence, not just on the project, but also on the operator, because I hear horror stories. I mean, you would be shocked at how many people are in cahoots with title companies, notaries, appraisals, contractors. You know, we've had deals, we had one last week, and it was an entity selling a property. We were going to provide the funding to the person buying it. Come to find out, when we started weeding through all the due diligence, the original owner that was selling it was actually someone we had already foreclosed on. The real estate agent was his son, and they were in cahoots with someone from the title company. So super scary. So do your homework, look through everything. It's really important because those things stick out like a sore thumb. They're huge red flags. So fraud is out there. Make sure you are working with a reliable operator and then doing your own due diligence above and beyond there. So initial due diligence, this is totally going to depend on someone's experience. You know, it's going to depend on how many deals you've funded in the past. I have guys that I've done business with, selling notes to for 15 years, and they don't look at anything because they spent the first 5 of the years of their life combing through all this stuff, but they have a comfort level with us. You know, until you're in that place with an operator, you're going to have to take this stuff on yourself. As you become more familiar with analyzing, you know, real estate note deals, you will start to build efficiencies in your due diligence. And then your purchasing criteria will also narrow as you continue to purchase notes. So you kind of got to start somewhere. It does get a little easier, especially when you have a track record with an operator, you know, whether that's us or somebody else. But until then, you got to dig in and do the homework on it. It's your capital. It's really important for you guys to understand what you're getting into. So basic elements of initial due diligence. These are things that I would say, just start with this. Decide whether you want to, you know, make a decision or a list of any of the states that you're not looking to invest in. Some of our clients are very specific. Hey, I only want deals in Texas and Florida. Hey, I only want deals in Ohio and Illinois. Whatever that list is, decide what that is. Filter out any cities that don't pass your criteria. Third, strip out any of the properties that do not meet your criteria. Some people don't like properties that were built before 1950. Some people don't like manufactured homes. Some people don't like properties on land. You got to figure out what your appetite is. And then it's a lot easier to really just kind of sift through the due diligence. The next thing would be to strip out any notes that don't meet your overall strategy. So, decide what you want to see out of a borrower. Some of my clients could care less what a borrower's like. They are very specific about the property because that's the reality, that's their security. But I have other people that are like, hey, I want to see that someone has a job. I want to see what their minimum credit score is. If they're a repeat borrower, I want to see their payment history. These are things we provide in our loan packages to our clients that buy trust deeds. So if you're working with anybody else that's not providing you that, ask them for it. They have that information and you should get that and should be able to review that. Fifth, and this should probably be first, confirm you have valid title insurance. We only accept title insurance from nationwide title companies. There have been situations 10 years ago where we accepted title insurance from a mom and pop title company that was gone after 12 months. Pretty hard to make a title claim when the title company's closed. So your big ones are going to be First American Title, Stewart Title. So make sure that if there is title insurance, it's with a big national company that can actually back up their policy in the event that you ever have a title claim. Make sure that there's updated hazard insurance. That's so important. And make sure it's being tracked. People can provide you with a hazard insurance policy and 10 days later they can go cancel it and then the property's uncovered. There are companies out there that will track hazard insurance and they will let you know immediately, hey, there's been a lapse in insurance. Good news is now you have forced plays. So super important, especially with all these crazy storms going on. New Jersey, Texas got hit, Florida. So very important. Do your due diligence on the property, review the most recent appraisal or inspections. And here's one thing that I see a lot is, oh, I got an appraisal, but there's no interior pictures. That makes me very concerned. Properties can look very different from the curb as you could walk in a house that looks beautiful from the outside and it's completely gutted on the inside. Regardless of whether you look at an appraisal or a hybrid inspection, make sure you have interior current pictures so you can see what the condition of the property is. That's really important. We do not accept appraisals unless they have interior photos. We want to know what that house looks like inside. If there's rehab involved, validate there's a licensed and bonded contractor's bid outlining the work that's going to be done. It doesn't mean the borrower has to use that contractor. But what makes me feel warm and fuzzy is that a third-party contractor went in there and said, this is what needs to be done to get this project done, not some do-it-yourself or, home project guy that is trying to cut corners and, do the project cheap. I want to know exactly what that property is going to cost to rehab so that in the event I take it back, I can anticipate that and I work that into my numbers. Review credit and background reports. We don't have a minimum credit score. We look at the whole picture. A lot of people, we just have one today. She had very low credit, 550, but it was because she was deployed and unable to make her car payment. All her other credit had been paid like right on time. So to me, that makes sense. But the guy that has 500 credit that never pays anybody and never has is probably not going to pay you on time either. So I'm not saying that you need to have your minimum credit score. You can if that's your appetite, but make sure you look at a current credit and a background report. We look at background reports mainly for white collar fraud and things like that. And it's shocking how often sometimes that comes up. Okay, so let's just talk a little more granular and I'll get through this because you guys all might have questions. Note investing due diligence checklist. So the things that you want to look for, you're going to do due diligence on our property, taxes, titles and liens, collateral review, and legal. Okay. So property data points. So these are things to look at when you're looking at the property. You need to understand, are there any HOAs or which are homeowners associations or condo associations? It's important to know that. How many bedrooms and baths? When was the property built? What's the lot size? A lot of that information you're going to get on your appraisal or your hybrid evaluation. Some of the other things you might look at is crime rate. You can find that on Trulia. You can look for flood zones on FEMA flood map. You also want to know what average rents are. If you take that property back and you're in the middle of winter, you're better off renting it and getting it cash flowing. So understand what your potential rents could be. You can find that information on Zillow, Rent-A-Meter, and Trulia. So there's a lot of online information you guys can find on these properties. Again, get your appraisal, city data points, and these are things that we don't look at as much, but I know other people sometimes do, is what's the population, we do look at the surrounding areas, current vacancy rates. If this borrower is relying on rents to make their payments, it's probably important to know what the vacancy rates are. So these types of things aren't always going to be applicable, but these are important things to understand in the case that they do. A lot of that can come from USA.com or the United States Census Bureau. Another big thing, always make sure if there is a septic system or a well on the property, that there is an inspection. The last thing you want to do is lend on a piece of property and discover that there is no water. I'm personally having a well drilled and it is not cheap. So if there's a well or a septic system on that piece of property, make sure that somebody got an inspection of those. And if they don't have it, require it. Again, eyes on the property is crucial. Get an idea of the cost of repairs. So this is just kind of an average kind of, if someone's saying, hey, here's a contractor's bid, this is what we're doing, you can run quick numbers. So if it's cosmetic and light repair, it's probably going to be about $10 a square foot. If it's medium, it's going to be about 15. And if it's heavy, if they're putting new electrical, plumbing, framing in, you're probably at $20 a square foot. And that's just a way to run rough and dirty numbers, just so that you can better educate yourself. Hey, this is a valid contractor's bidders, or heck no, you're not going to get this project done for that much. What are you thinking? So just kind of keep that in mind. It's just a tool for you guys when you're starting to go through these. So the other things to understand when you're doing your due diligence is title report, vesting information, who owns the property. If it's a purchase, does that person that's selling it even have the right to sell it? I've had that come up. There's someone else on title and the purchase and sale is signed by a seller with a completely different name. Title reports will uncover things like that. You're going to find out if there's any recorded mortgage or assignments, if there's federal, state, and municipal liens. Title reports will identify that. HOA liens, civil judgments, foreclosure proceedings, property tax delinquencies. All this stuff is important. It doesn't mean that a deal can't be done with those kind of things on title, but it means that those things have to be satisfied when the loan closes, so that it's all wiped off and taken care of. And now you're in, whether you're in a first lien position or second, those things should be cleaned up. So title is really important. Confirm the lien position of the note you're purchasing. That is evidenced through title insurance. One of the other things that came up, superior lien states. So there are some states where HOA, homeowners association, and condo association liens automatically supersede a first lien position. So it's important to understand that, because then you need to make sure that those HOA and COA dues are being paid. Okay, so understand that, do your research on that. Make sure property taxes are current. There are two different types of tax lien states. Tax lien states are delinquent property taxes that are sold to the highest bidder at public auction in the form of a tax lien certificate, and tax deed states are won by a borrower that are actually purchasing the property, effectively owning the real estate free and clear. So the worst thing you could do is not make sure property taxes are paid current, because the people that buy those liens and those deeds supersede first lien holders, and they can foreclose. They could go buy back property taxes for $10,000 and foreclose on it, and now you're out your $100,000 that you lent on it. So super important, make sure taxes are current and track those. Most servicers should be able to track property taxes, and if they don't, let us know and we can help you with that. There are services out there. So making sure property taxes is really important. So there's collateral review. When you're buying a trust deed, any operator or individual that's trying to get you to buy this trust deed should be giving you guys this stuff. We call it a loan package. It's actually our collateral file, and it does contain the following. So you want to see a copy of the mortgage or the deed of trust that you're buying. Okay, so that's the security instrument that is the recorded lien against the property. You want to make sure if there's any riders to that mortgage, that those are identified on there. Those are riders like adjustable rates or Some lenders will build in automatic extensions. They'll write a 6-month loan and they'll say after 6 months, if they're current, they automatically get another 6 months. That's important to you guys because then you know how long your money's going to be tied up. You want to see copies of the note and any note addendums. You want to see, again, the title policy. Look at the final HUD. Now, this is only going to come into play typically with your purchase transactions, but everybody should have a final HUD when that loan is finally closed, even if it's a refinance. And the importance to that is then you can see where all that money was dispersed out, right? If someone says, I bought the property for 50, you lent me 100, I'm going to put 50,000 into rehab and I'm taking the other 50 and buying it, then on that HUD, it should show what the purchase price is, that it was $50,000. If those numbers don't match up, something's not right. So you should be able to review a final HUD. Allonges to notes, assignments of mortgages or deeds of trust, appraisals. You want to see contractors' bids. If someone tells me, hey, I'm putting $50,000 into it, that's great. Show me your contractor's bid. I want to see exactly what's being done. And that'll be line item. You know, they're putting $5,000 into electrical, and then you hold them accountable to that. Because the last thing you want to do is front a bunch of money for rehab funds and they take off with it and they don't rehab the property. So at least with the contractor's bid, you can control those funds. You can make sure that those funds are being dispersed as they should be. Any notes so if this is an existing note, this is a little different than a newly originated note. But if you're buying paper that is, 12 months old or even longer, ask to see the servicing notes because they're going to show you any communication they had with the borrower. Maybe they're saying, yeah, this note's current, you should buy this. And then you get the servicing notes and you can see that he just got current. He hasn't been current for 12 months and you can see all the notes in there. You have a right to look at that if you're buying paper. Borrower's credit reports, and I would say look for a current credit report, not something from a year ago. And then this is the big one. There is a lot of fraud with notaries out there. I have been shocked at how much we've caught. Confirm that if a borrower is signing a document that's been notarized, that person that notarized that, the notary, has a license in good standing. You'd be shocked at how many documents we catch where it's a fraudulent notary. Anybody can just about get a notary stamp, but you have to stay compliant and you have to do things to keep your license active. People will get it, let it lapse, and then, sometimes they're in cahoots with the borrower. So just make sure if there's any notarized documents, look up the notary, go to the state that they're licensed in, and you can see if they're in good standing. It's really important. You can catch a lot of fraud just identifying, little things like that. All right, we already talked about loan servicing reports and pay history, credit reports, clear chain of assignment and title. So that chain of title is going to show up on a title report. You're going to be able to see this is the person that owns it. That person bought it from this person. They had a mortgage. That mortgage was paid off. Make sure that you can see a chain of title and that you have clear title for your lane. All right. So let's talk about legal things. These are things that you can do on your own for due diligence. But if you do have bigger concerns, I really suggest seeking out legal advice from an attorney. But things to be mindful of, and a lot of people don't think about this. When you buy a note, depending upon where that property lies, there are different foreclosure laws. It is dictated by the state that they're in. So there are judicial foreclosure laws versus non-judicial foreclosure states. Judicial is going to mean that it is a longer, more expensive process to foreclose. And your non-judicial, like Texas is a great example, are shorter and typically cheaper. Some of my clients don't care. They are, again, focused on the asset. Some of my clients are very, very concerned with foreclosure laws, and that's okay. But understand that that is typically dictated by the state that you're foreclosing in. So if you have concerns about that, what I would suggest is do your research. There's tons of information online, and you can actually get maps that will tell you these are the judicial foreclosure states and these are the non-judicial, so that when you're looking at paper, you can say, if this is something that's very important to you and is part of your appetite for notes, you can eliminate the ones that are in the states that you're not interested in, okay? Understand or identify if something's in pre-foreclosure. Again, That and active foreclosure is typically indicated on a title report. Look for somebody that's in active bankruptcy. We've had that come up, somebody trying to borrow from us. We pull a credit and background report and we realize they're in the middle of a bankruptcy. They cannot borrow money. They have to go to the bankruptcy courts. That's why credit and background reports are super important. Previous bankruptcies aren't as concerning unless they're in like the last 24 months for us, and they need to be explainable. Everybody has life situations, but if you do see previous bankruptcies on a credit report or title, make sure you ask what happened. Everybody's got a story, and I think that's the least they can do if they're trying to borrow money, right? So just understanding those things, looking for those things, and don't be afraid to ask questions. It's your money. You have a right to ask questions and understand exactly what you're getting into. So don't be afraid to do that. So our notes that we offer at SIC or trust deeds are very short term, 6 months to 24 months, and they start at $30,000 and they go up from there. So we do have very small notes. You do have to buy a whole note. And then we also only lend in a first lien position. The other thing to look for, and because these are non-owner occupied properties, we only lend to an LLC. So our borrowers have to have an entity in good standing that's registered. But we also make all the members personally guarantee the loan. And that's a really nice added level of security, because then if they don't make their payments, you take a property back and you may potentially experience a loss, which we would hope that never happens. You actually can go after them for a deficiency if you have a personal guarantee. So personal guarantees are great. Always ask if they're available. I don't believe you can actually do that on an owner occupied trust deed or note, but on anything non-owner occupied, you absolutely can ask for that. So be aware of that and know that that's just an added level of and layer of security for you. All right, we offer interest-only payments. Our borrowers all have to make interest payments every month, which then are dispersed to you on a monthly basis. We lend against residential, single-family, 1 to 4 units. That is our niche, and that's our lane. We don't do any commercial, and we do provide funding for purchases and refinancing. And these are all newly originated loans. They're performing loans. They're fully underwritten. We've already closed them with our own funds, and then we're selling the paper. So these are not discounted notes. They are performing and newly originated notes. So I mentioned finding a good servicing company. So I want to kind of wrap this up. I'm not here to promote me or Lake City Servicing, but I am here to promote you to find a good servicing agent, because it's very, very important. Finding the deal, doing your due diligence and making the decision to buy it is just the tip of the iceberg. The hard work comes in servicing it and making sure those borrowers are making their payments. So look for someone that's going to collect and disperse monthly payments. They're going to monitor your hazard insurance and property taxes. You need to look for a servicing agent that is going to do end of the year tax reporting. And then also our servicing company, and not all do this, but find somebody, whether it's a servicing company or your operator, that's going to provide you with all the original loan documents after the deal closes. And then find someone that, has services like foreclosure management and REO management. We don't like to talk about that, but that is the risk in doing this. And you need to be prepared so that in the event that you need to say, hey, start foreclosure, they can do that quickly. So, they should be able to provide that. Again, that's something we do here through Lake City. So if you have outside notes or trust deeds, that's something we can help you with too. So I like this diagram, because a lot of people are like, I don't understand, I do my due diligence and then what happens? So I like this life cycle. So basically what happens, you're going to identify your potential deed or note. You're going to do your due diligence. We do a lot of it for our clients, but I encourage our clients to take the information in the due diligence package we have and do their own. Once you do your due diligence and you decide what you want to fund, you're going to invest. Most people do digitally signed documents that are secured online. You will transfer funds. You start earning your monthly interest. Again, annualized returns 8 to 11%. And then once the project completes, the borrower repays the loan and you returned your principal, and you can start the whole process over again. So, it's pretty easy once you've done it enough times to really understand what your due diligence process is. Everybody has something different, but just find where you're comfortable. So I thought this was neat. I wanted to give you guys just a couple examples with real numbers and real properties of deals we've done. So I'll go through these quick. I know I'm kind of taking up a lot of everybody's time, so I want to have time for questions. This was actually a deal out of South Carolina we recently funded. So we lent this borrower $45,500. This property had an after repair appraised value of $65,000. So that's the value after the property's rehabbed. This borrower brought in a down payment of $10,859 and some change. Our investor that bought this note is earning 10%. Of the $45,500, $21,450 is held for rehab. So almost half of that is going to rehab. Our loan to value is 70%. So we have a great equity position, 30%. This is a loan term of 12 months. Obviously the proceeds were used to purchase and rehab the property, and this client was selling the property. These are actually before and after pictures. I thought they did a great job. The black kitchen above was when he bought it. He went in, put white cabinets in, redid the floors. So he did a great job on it. But the really exciting thing was the lender that funded this note bought it for $45,500. They were receiving 10% annualized rate of return on this, and they were receiving a monthly payment of $379 and some change. So they're growing their investment. Overall, on an annualized basis, they received a little over $4,500 in interest payments. So pretty awesome return on their investment on a property with 30% equity, right? All right, here's another one. I'm just going to give you two examples. This was a loan out of, looks like Maryland. Loan amount was $88,700. This property had an after repair appraised value of $160. So again, that's your rehab finished completed project. This borrower brought in a little over $14,000. We had a note rate of 11, but we sold it to an end lender for 9%. So that means that the payment in servicing was split up. Funds that we held in escrow to complete the rehab were $61,000 and change. This had a great LTV. This was a 55% loan to value. So we had a 45% equity position in this. I mean, honestly, with that kind of equity, some of my investors are like, I kind of hope he doesn't pay. I mean, that's not our intention, but you have to look at this like, do I want to take that property back? And I think that's where some of our clients that have not been successful buying notes, they're too wishy-washy. Well, I don't know. I don't want to foreclose. No, you have to. That's what is securing your money. And the quicker you get that property back in your name and you're controlling it, the safer your investment is. So you have to be able to make that decision. So this lender that funded this was receiving 9%. So they were getting $660 and change every month in interest payments for annualized return of over $7,900. So really good opportunity. All right. So when you guys start looking at deals, ask yourself these questions. How much are you looking to invest? If you've got 50 grand, there's no reason to look at trust deeds for $200,000. Decide what that is. Do your due diligence. Look at what the borrower's experience is, what their money into the deal is. Are they a repeat borrower? My clients love to lend to repeat borrowers. Half the time when they see a repeat, they're like, I'll just take it. Because first of all, we don't lend to anybody if they go 30 days late with us. So repeat borrowers have huge reputational capital. Look for pay histories. Again, look at your rehab schedule and your budget. Understand where the property is located. Look at borrower's credits and financials. And then again, understand what your loan to value is, because that's your risk, right? Do you have a 10% equity position or do you have a 45% equity position? I'd rather have 45 than 10. So it's important to understand that, okay? All right, so enough of my time. If you want more information about trustees and just want to become more educated about it, please call my department. We'll help you. If you actually want to look at trustees, you can actually go to our website at securedinvestmentcorp.com. We actually have all of our trustees listed on our site, and you can get a lot of information. A lot of our clients go there. They call it the home shopping network. Hey, I saw that deal in Texas. I want to look at that. And then what we do for our clients is we give you a due diligence package. So everything, all the documents we use to underwrite the deal, application, appraisal, borrower's credit, financials, tax returns, contractor's bid, we put that in a big PDF for you. And we give that to you, and then we encourage you, hey, go do your due diligence. Let us know what you're thinking. If you have additional questions, let us know. And we try to make it as easy as possible, but I also encourage you guys to do your own homework, because I think that's very valuable. And even just looking through those files and just, getting yourself familiar, even if you do it outside of us, just make sure you're getting title. All those things that I mentioned are so important, because I can't tell you how many calls I get. Well, I knew a guy, he said he paid me 15%, he paid for 30 days and I never heard from him again. It's like, oh my gosh, don't do that. And if you are going to do that, make it set up through title, make them close with an attorney, protect yourself. You guys worked hard for your money. It's important for you guys to protect yourself and not be afraid to ask people questions, because you should. Okay. All right. That's all I got. I feel like I talked forever.
That was very informative, Heather. I would like to open the floor. If anyone has any questions, go ahead and drop them in the chat, and Heather can answer those for you.
Let's see.
I always have to tell people to not be shy, because everyone is so afraid to ask the first question.
Oh, come on. You guys must have some good questions here.
Oh, I see one here. Looks like.
Oh, what's the minimum you could start with? So we at SIC only sell whole notes, meaning if it's a $30,000 note, you have to buy the whole note. So our minimum is $30,000. That's as small of a deal as we'll fund. And what I tell people is, if you're really specific and you have under 100 grand, get a hold of my team. And what we like to do is cherry pick deals for people. Okay, Kenya's got 30 grand. We know she likes deals out of Texas. And when we see those deals come through, we like to hand those off to our clients that have spent some time just, on the phone with us, better understanding what your strategies are and how risk adverse you are. And then we can help kind of spot place some deals for you. I will tell you, within our company, deals under $100,000 sell like that. I had two this morning. I had a deal for 70 and a deal for 36, and they sold within literally probably 30 minutes of us marketing them. So that's why I say, if you have a smaller balance, you can let us know. Or it doesn't matter if it's a smaller balance or you're specific to certain things, we can pretty much satisfy everybody's appetite. We just kind of need to know what your profile is. But ours is 30,000.
All right, Heather, thank you for that. We also have another question from Lizanet. When you say find the property, if we are a client to your company, do you pair us as the lender with the borrower, or do I have to find the property borrower and bring them to your company for you to service the loan?
That's a good question. We do both. So I'll tell you how we started servicing notes. I've been with this company 10 years. We tried to outsource servicing, and it was quite honestly a nightmare. And so we brought it in-house 9 years ago. We invested in the software system. And for a long time, we only serviced our portfolio. So what I mean by that is the notes that we originated and sold, we would only service. Well, we now do outside servicing. So we do both. If you buy a trust deed from us, we service it because it's already set up in our servicing system. So that means you can get set up on ACH payments. For those folks that have self-directed IRAs, we're really awesome with working with custodians. So we're very flexible with that stuff. However, if you're an active trust deed note buyer already and you're looking for a servicing agent, we can also service the notes that you bring to us. So we can do both.
Thank you, Heather. That's awesome. Does anyone have any other questions? We have an expert with us. Okay, let's see in the Q&A. That was going to be my next question. Can you invest via IRA or Roth IRA?
Absolutely. So we work with any self-directed IRA custodian. Some of you folks might have checkbook IRAs. So absolutely. And we will even go to the extent, let's say you decide, hey, I want to fund that deal. Here's my self-directed custodian. We'll fill out all the forms for you. Most custodians also want to see a copy of the note and the deed of trust or mortgage. We'll do all that work for you. You just have to let us know. This is the account I'm using. And then the other thing is, when that assignment of mortgage is recorded, it'll be recorded in your IRA's name. So we want to make sure that you don't have any tax implications. So my team is very familiar working with self-directed IRAs, and it doesn't matter whether it's Roth, traditional, or 401k, we can do any of that.
Next question. Do you lend in all states?
We lend in 95% of the states. There are some states that require licenses, which we are typically licensed in. There's some that don't require licenses because we only lend to non-owner occupied properties. So they technically are for business purposes only. But there's probably 4 or 5 that we are not lending in currently, but the majority of them we're active in.
All right. Heather, you have been so thorough in answering all these questions. Does anyone have anything else that you want to add or ask? I know that your line is also open. Oh, I see another one. Would you be able to use a group investing in notes?
Yes. So I have a gal out of Illinois who's a doctor, and what she did is she created an LLC. And so she has colleagues and family members that invest in her LLC, and then her LLC owns the note or the trustee. I also work with, some more institutional funds out of Wall Street that are more essentially entities or groups that buy our deals. So yeah, the only thing that we can't do is we can't do fractional interest. Like I can't say, Brittany, you're going to own 10%, Heather's going to own 50, and then I'm going to go find someone else for 40. I can't break up the payments because that is a securities violation, and we are not a licensed securities broker. But that doesn't mean that you can't form an entity and invest that way. So I can talk offline about that. You can always reach out to me. There are some options for that.
Awesome, Heather. Oh, thank you, Liza. She said it's been a great presentation. Thank you, Heather.
Thank you. Yeah, we would love to talk with anybody. If it's just educating or you really want to look at some of the trustees we have, I encourage you to go to the website or call. That number directly comes to my office. There's 3 of us in the office, and we'd love to talk with you guys more and answer any questions you might have.
Cool. Thank you, Heather, so much for your expertise today. We really appreciate you joining, and I will have this also recorded for those who want to watch it again or just give Heather a call, and she'll be happy to answer your questions.
Thank you for having me.
Yes. Take care, everyone.